If you care for an aging parent for free, you are probably losing thousands a year, because caregivers already spend about $7,200 out of pocket. 5 real programs pay families instead. 1 is LAST. Here is the scale. About 63 million Americans, nearly 1 in 4 adults, gave ongoing care in the past year, according to a ARP. Nearly half of them took on debt or stopped saving. They paid roughly $7,200 a year themselves. Now compare that to facilities. In 2024, median assisted living ran $70,800 a year. A private nursing home room hit $127,750 per Genworth and CareScout. Care number 4 is the one almost nobody applies for. First, the biggest one. Medicaid can pay you to be the caregiver. Most people picture Medicaid paying a stranger from an agency, but many states run self-directed or consumer-directed programs, sometimes called cash and counseling, where the parent picks the caregiver and that caregiver can be their own adult child. 11 states also run structured family caregiving. They pay family members roughly $40 to $70 a day, according to reporting on Medicaid's 2025 home care rules. To qualify, 2 things must line up. The parent has to be Medicaid eligible, and they must need a covered level of daily care. Then the adult child gets hired and paid as the caregiver. Why does it work this way? States would rather pay a trusted family member a modest rate than cover a $70,800 facility. Here is the catch. Pay is low for the hours, and it varies by state. Where to start? Call your state Medicaid office or your local area agency on aging. Next up, one that only opens if a parent wore the uniform. Here is where it gets expensive if you skip it. If your parent is a veteran, the VA has 2 ways to fund a family caregiver. The first is veteran-directed care. It gives a budget the veteran controls and can use to pay a family member. The second is the aid and attendance benefit. This one is added on top of a monthly VA pension for veterans or surviving spouses who need help with everyday activities like bathing, dressing, or eating. To qualify, you are generally looking at a wartime veteran or their surviving spouse with a real need for daily help. How do families apply? Through the VA directly, or with a VA-accredited representative who does not charge to file the claim. Why does this matter next to Medicaid? Because it is not tied to Medicaid's income limits at all. It is a separate pension track. The trade-off is paperwork and proof of service and need, which takes time. Still ahead, the option families use when the parent has money but no benefits. Third, a written caregiver agreement. Sometimes the parent has savings but qualifies for nothing else. In that case, families set up a personal care agreement, a plain employment contract that pays the caregiver from the parent's own funds. Elder law attorneys stress one rule: put it in writing. The contract sets an hourly or monthly rate, spells out the duties, and logs the hours. Remember, we still have not hit number 1. Why does the paperwork matter so much? 2 reasons. First, if the parent later needs Medicaid, an undocumented cash handoff can look like gifting away money, which can delay their eligibility. A signed agreement shows it was fair pay for real work. Second, it keeps the tax side clean, income versus a gift. This ties straight to the succession theme running through this channel. Build the document early, before there is a crisis, and keep every record. The trade-off is honest. Paying market rate drains the parent's savings faster. Next, the option that reimburses you from a policy the parent already bought. Fourth is the one almost nobody applies for: insurance that pays a family caregiver. Many people assume long-term care insurance only pays a facility, but some long-term care policies and some life insurance policies with a long-term care rider will reimburse an informal caregiver at home instead. That rider is simply an add-on that lets the policy pay out for care. Here is why families check it hard. Reimbursing a family member at home can cost far less than $70,800 a year for assisted living, or $127,750 for a nursing home room. The mechanism is that the policy pays a daily or monthly benefit once the parent needs help with daily activities, and in some contracts, a relative can be the paid caregiver. The catch is the fine print. Many policies require a licensed agency or bar family members entirely, so the concrete step is to read the specific policy language or have an agent confirm in writing whether a family caregiver qualifies. Last one, the path that runs through your tax return. Fifth, the one that shows up on paper, tax relief that effectively pays you back. If you cover more than half of a parent's support and their income stays under the IRS threshold, you may be able to claim them as a qualifying relative. That can bring the credit for other dependents, worth up to $500. If you pay for a parent's care so you can keep working, the child and dependent care credit can cover part of that cost too. And here is the one people miss. Qualifying medical expenses you personally paid for your parent can be deductible if you itemize. So where does the money land? On your federal return, as a smaller tax bill or a bigger refund. The trade-off is the rules are strict. Income caps, that more than half support test, and the itemizing threshold all have to line up, and not everyone will qualify. The mechanism is simple. The tax code quietly rewards people who financially carry a dependent parent. Now the full payoff. So there are the 5 paths. Medicaid self-directed care that pays an adult child $40 to $70 a day in some states. VA benefits for a veteran parent, a documented caregiver agreement paid from the parent's own funds, insurance that reimburses a family caregiver at home, and tax credits that shrink your federal bill. Here is the single first move. Call your local area agency on aging, one phone call, and ask them to check Medicaid and VA eligibility for your parent. Then, whatever arrangement you land on, put it in writing and reframe what respect your parents means here. Getting paid is not taking from them. It is what makes the care sustainable when the alternative is a $70,800 to $127,750 facility bill every single year. A supported caregiver lasts. A broke one does not. Honoring an aging parent and getting paid to do it are not opposites. They are how the care actually lasts. If succession and family money is the bigger question on your mind, our breakdown of the $124 trillion wealth transfer and how families avoid the fights that blow it up is on your screen now. Subscribe if you want the unglamorous money math. This is information, not financial or legal advice, so do your own research.